Good evening and welcome everyone to the webinar. I really appreciate you taking the time to join me. First and foremost, I would like to thank my marketing specialist, Mariah Johnson, and my compliance team at Dividend for helping me put this together. We'll go through the standard disclaimer. The following information is being presented on the understanding that it is intended for information purposes only. None of the presenter, Desjardins Financial Security Independent Network, or Desjardins Financial Security Investments, Inc., have been engaged for the purpose of providing legal, taxation, or other professional advice. No one should act upon the examples or information without a thorough examination of the legal and tax situation with the appropriate professional advisors. Well, now that we got that out of the way, my name is Mehul Gandhi, and I'm a certified financial planner professional serving clients in British Columbia and Alberta. And today, I'm going to present to you the definitive RRSP guide just in time for the RRSP season. So, here's the agenda. Our presentation is split into 3 parts. Part 1 is going to tackle the basics of RRSPs. Part 2 is going to look at what happens to your RRSPs when you pass away. And Part 3 is going to get into RRSPs for business owners. I urge you all to stick around all the way till the end, at which point I'll be answering your questions. Okay, so let's start with what an RRSP is. A registered retirement savings plan, or RRSP, is a registered account designed to help Canadians save for retirement. The money in an RRSP can be used to buy a whole host of investments, such as mutual funds, segregated funds, term deposits, GICs, and many others. While the investments are held in your RRSP, you won't have to pay tax on any interest, dividends, or capital gains you earn. Now, a couple important things to note. The RRSP is a vehicle, not the type of investment. I can't tell you how many times people have asked me what type of rate of return I can get in an RRSP. Again, the RRSP is not a type of investment. It's a vehicle that contains many different types of investment products. You can have as many RRSP accounts as you please, provided you do not violate the contribution rules. So, how does an RRSP work exactly? The RRSP allows you to invest your after-tax money during your working years. While the money is invested in your RRSP, it grows on a tax-deferred basis. When you withdraw the money from your RRSP, in most cases, it's all taxed as income at your marginal tax rate. Now, you can contribute to an RRSP as long as you have contribution room. Your taxable income is reduced by the amount you contribute to your RRSP in a given year. And after the age of 71, you can no longer have an RRSP. One option is to convert it to a registered retirement income fund, or a RIF, at which point you must make minimum annual withdrawals. More on this later. Now, time for a fun fact. Did you know that there used to be restrictions about holding foreign content in your RRSP? That is, securities and funds in companies that are not Canadian. But the February 23rd, 2005 budget eliminated the foreign content limit completely for RRSPs and RIFs for 2005 and years later, in the later years rather. If desired, RRSPs can now consist of 100% foreign content. Let's take a moment to talk about a special type of RRSP called the spousal RRSP. A spousal RRSP is an RRSP that is registered in your spouse's name and controlled by him or her. As for all tax situations, the rules apply equally to common law partners and married couples of either or the same sex. Some important things to consider. The contribution limit for a spousal RRSP is limited to the contribution room of the contributing spouse, not the spouse who controls the account. Now, the main purpose of setting up a spousal RRSP is to balance your RIF income withdrawals among spouses in retirement for tax efficiency. Caution though, funds can only be withdrawn 3 calendar years after contribution to avoid attribution of tax back to the contributor. An additional benefit is the ability to double the home buyer's plan maximum withdrawal limit of $25,000 per spouse. It could make sense for your spouse to make withdrawals from a spousal RRSP if he or she is taking unpaid leave from work. Or you might have a spouse that is younger than you, and making contributions to their spousal RRSP could defer your his or her RRIF withdrawals, since he or she will turn 71 after you. Now, as a financial planner, one of the most frequent ways I help my clients during RRSP season is to help them calculate and understand their RRSP contribution room. There are a few things to consider when calculating how much you can contribute to your RRSP annually. Luckily, this calculation is made easier by looking at your most recent notice of assessment or logging into your CRA My account online. The CRA calculates your deduction limit for you based on your income earned in the previous year, any pension adjustments, past service pension adjustments or pension adjustment reversals, used RRSP deduction room at the end of the previous year. Your deduction limit is 18% of your earned income up to a maximum value for the given year. The maximum RRSP contribution room for the 2018 tax year is $26,230. Unused contributions are carried forward each year, so if you didn't maximize your RRSPs in previous years, the unused amounts are added to this year's limit. And we should not forget that there's a one-time $2,000 over-contribution allowed. Now, there's a particular over-contribution strategy that can be used in the year you turn 71. You can make contributions to your RRSP until December 31st of the year you turn 71. When you contribute to your RRSP, you pay a 1% penalty per month. However, if you earn income in the year you're 71, this strategy may help. Towards the end of the year, you turn 71, estimate how much RRSP room you'll have created that year, typically 18% of your earned income up to the annual maximum. Make an additional RRSP over contribution before December 31st of the same year. And then you file a T1 OVP form to report the over contribution to CRA and remit the penalty for the month of December. You do have up to 90 days of the following year to remit that penalty. Now, you deduct the additional RRSP contribution on the following year's tax return or carry it forward to any future tax year. On January 1st of the next year, the RRSP over contribution you made in December will no longer be considered an over contribution. Let's look at an example. If your RRSP contribution limit for the tax year you turn 71 is $20,000 based on the year's earned income, you may want to contribute that amount, $20,000, to your RRSP before the end of December of that year. You will have a one-time penalty of $180. That's derived by the $20,000 over contribution minus the $2,000 one-time over contribution amount times 1%, which is $180. Of course, this example assumes you've not used your allowed $2,000 lifetime over contribution amount. The advantage of making this contribution significantly outweighs the nominal over contribution penalty. However, this strategy should be carried out under the guidance of a tax or financial professional who is familiar with it. So, you've been disciplined and proactive to create a sizable RRSP account. But how do you access that money? Do you have to wait until retirement? You're allowed to withdraw your money anytime you like from an RRSP. When money is withdrawn from your RRSP, in most cases, it is counted as income and tax will have to be paid. It is, for this reason, not recommended that you use your RRSP for short-term savings like vacation or even an emergency fund. The tax-free savings account, or TFSA, or even a non-registered account would be more appropriate. You might want to consider withdrawing money from your RRSP in a year when you're not working. For example, parental leave, a sabbatical, starting a new business, or even a travel year. The Home Buyers Plan and Lifelong Learning Plan are two ways to withdraw money from your RRSP without it being treated as income. But it does have to be paid back in a specified amount of time. By the end of the year you turn 71, One option is to transfer your RRSP to the RIF. Your RIF will begin to pay you a minimum income based on your age. Let's look at the Home Buyers Plan and Lifelong Learning Plan more closely. The Home Buyers Plan is a program that allows you to withdraw up to $25,000 in a calendar year from your RRSPs to buy or build a qualifying home for yourself or for a related person with a disability. You're considered a first-time home buyer if in a four-year period you did not occupy a home that you or your current spouse or common law partner owned. Your RRSP contributions must stay in the RRSP for at least 90 days before you can withdraw them under the Home Buyers Plan. And you must repay the borrowed amount within 15 years at a minimum amount of 1/15 of the borrowed amount a year. Missed payments are considered income in the year they are missed. The Lifelong Learning Plan is a program that allows you to withdraw amounts from your registered retirement savings plan. The RRSP, to finance full-time training or education for you or your spouse or common law partner. The student is enrolled or has received an offer to enroll on a full-time basis to a qualifying program and institution before March of the following year. The RRSP owner must be a resident of Canada. If you've made a lifelong learning plan withdrawal in a previous year, your repayment period must not have begun. And you can withdraw $10,000 a year and $20,000 total. Okay, it's time for a tax break. You can take money out of your RRSPs before you retire for reasons other than buying a home or funding your schooling. Perhaps an emergency situation arises and you have no other options. But beware, you will pay an immediate tax on the money you take out and possibly more at tax time. And you'll permanently lose the contribution room you originally used to make the contribution. Your financial institution will hold back the tax on the amount you take out and pay it directly to the government on your behalf. This is called the withholding tax. The withholding tax rate is between 10 and 30%, or 5 and 15% in Quebec, depending on how much you take out of your RRSPs. There will also be provincial tax withheld. You can see the federal withholding tax rates on the right-hand side of the slide. Additionally, you have to report the amount you take out on your tax return as income, and at that time, you may have to pay more tax on the money, on top of the withholding tax. It depends on your total income in the year of the RRSP withdrawal and, of course, your tax situation. Now that we have a handle on what an RRSP is and how it works, let's go through a very simple example that illustrates the benefits of an RRSP. A BC resident with a $95,000 a year salary in 2018 would receive a tax refund of about $2,493 on a $7,500 RRSP contribution. Meanwhile, a retiree earning $40,000 would pay barely $1,800 of income tax on a $7,500 RRSP withdrawal. The benefit here can be calculated as the difference between the tax refund you received when you made the $7,500 RRSP contribution versus the tax paid when you made the $7,500 withdrawal in retirement. If you're in the highest tax bracket today, RRSPs make a lot of sense, as you can see. However, if it's likely that your tax bracket will be the same or higher when you retire, perhaps because you have a pension, rental, or royalty income, then the RRSP might not be for you. As the old saying goes, nothing is more certain than death and taxes. And now we're going to talk about both of them. Specifically, what are the tax consequences to your RRSPs when you die? When you die, the value of your RRSP is included as income in the year of death. It's as if you cash them all out just before you died. This amount is fully taxable at your marginal tax rate. However, as we'll see, there are some ways to reduce or even eliminate this tax upon your death. Let's explore them. First, the spousal rollover. If the beneficiary of the RRSP is a spouse or common law partner, It is possible to transfer the assets directly to that person's RRSP or RIF as a tax-deferred rollover. This is known as a spousal rollover. If the surviving spouse or partner is under age 71, we can transfer it to their RRSP. If they're over 71, these RRSP assets will be transferred to the survivor's RIF or eligible annuity. The surviving spouse or partner will then report the value of the deceased's RRSP or RIF on his or her tax return for the year, but will receive an offsetting deduction for the qualifying transfer. Similar options exist if an RRSP is left to a minor child or grandchild who is financially dependent on the deceased, or a child or grandchild who is financially dependent on the deceased taxpayer by reason of mental or physical infirmity. The next slide looks at how you can avoid paying probate on your RRSPs when you die by naming a beneficiary. At the time of your death, there is generally a requirement that your last will and testament be legally approved by the courts under the laws of your province or territory. The probate process also confirms the appointment of your executor, and each province specifies what documentation is required as part of the probate process. Most provinces charge a fee for probating a deceased's will. The fees can be as high as approximately 1.5% in Ontario to no fees in Quebec. In BC, probate fees is 1.4% on estate values greater than $50,000. If your RSP is left to your estate, it will be subject to probate fees. However, if you designate a beneficiary for your RSP, you will avoid paying probate fees on your RSPs. This does not necessarily mean it will avoid taxes. The next example illustrates exactly what I mean. Let's look at an important estate planning example involving named RSP beneficiaries. Now, some individuals will designate a child as a beneficiary to their RSPs so as to avoid probate. They believe they're doing the right thing. However, a greater understanding of the individual's wishes can warrant some slightly more intricate estate planning. Let's take a look at the following situation. Before passing away, Sandra designated her son James as a beneficiary of her RSP valued at $400,000. Sandra's will instructed that her daughter Darlene was to receive the rest of Sandra's estate, also valued at $400,000 at the time of her death. James received the full $400,000 RSP from his mom immediately after Sandra's death, since it bypassed her estate and was not subject to probate. This was the advantage of James being the named beneficiary to Sandra's RRSP. Unfortunately, the taxes on the RSP still had to be paid, and the estate was responsible for that, reducing the amount that Darlene received. Now, Sandra's intention was to treat her two children equally, but this is not what happened. One solution here could have been if Sandra was to designate both of her children as equal share beneficiaries for both the RSP and the estate. This way, James and Darlene would have received equal shares of the RSP and equal shares of the remainder of the estate after all probate and taxes were paid. Now, I work with a lot of incorporated small business owners, and a big debate is whether to take a salary or to take dividends. In fact, I personally had this discussion most recently with my own accountant. It's not uncommon for incorporated business owners to favor dividend income over salary. However, the tax benefit of this is essentially null in Canada's current tax environment. Did you know that RRSP contribution room is calculated based on earned income, which includes salary but not dividend income? And if your only source of income is dividend income, you will not be able to build RRSP contribution room at all. Consider paying yourself just enough salary to maximize your RRSP contributions every year. Contributions to your RRSPs are deductible against any kind of income, including dividend income. Paying yourself a salary also qualifies as pensionable earnings, which means you will be entitled to Canada's Pension Plan, or CPP. It does also mean, however, you have to pay into CPP, which some business owners prefer not to do. But Everyone has different goals and needs, so I encourage all business owners to sit down with their tax professional and their financial planner to devise a personalized strategy. It's important the immediate tax benefits are considered, but also weighed against long-term retirement planning. So this brings me to the topic of my next quarterly webinar. Let's take a sneak peek. As I mentioned, a salary qualifies as pensionable eligible income. Dividends do not. A business owner who receives pension eligible income may be a candidate for an individual pension plan, or IPP. What is an IPP, you might ask? An IPP is an employer-sponsored defined benefit pension plan designed to provide enhanced retirement benefits and important tax advantages. Some of these key benefits of an IPP include providing higher contribution room than permitted by the RRSP. IPPs also grow on a tax-deferred basis, just like your RSP. And additionally, IPP contributions are tax deductible to your corporation as the plan sponsor. In my opinion, the recent tax changes around passive income in corporations make RSPs and IPPs much more favorable for incorporated business owners than ever before. Stay tuned for information on next quarter's webinar, where we'll explore IPPs in detail, and we might even have a guest speaker. Well, that's it, folks. But before we go and open up for questions, here's some important information. The 2018 RRSP contribution deadline is March 1st, 2019. The 2018 RRSP contribution limit is $26,230. And as an aside, the 2019 tax-free savings account contribution has been increased from $5,500 to $6,000. Now, if you're not already doing so, please follow me on social media to keep up to date with my latest articles, events, and of course, future webinars. A recording of this webinar will be sent out to each of you to share and will also be posted on my social media. I'll now open up for some questions. You can type your questions in the messaging window so everyone can see it, and then I'll answer vocally so everyone can hear. Well, it appears that I either did a really great job at explaining everything there is to know about RSPs. Oh, we do have a question. Let's take a look. All right. Well, the question I have here is, can I highlight a couple of key benefits of seg funds in my RRSPs? Absolutely. So this is a great question. Let's go a little bit into what a seg fund is. A seg fund, or a segregated fund, is a type of fund similar to a mutual fund that is wrapped in an insurance guarantee. In fact, there's two guarantees that seg funds provide: a death benefit guarantee and a maturity guarantee. What that means is that every seg fund has a maturity time. Sometimes it's 10 years, sometimes it's longer, but upon maturity, you will have a guaranteed amount of your initial invested value or protected value that will be guaranteed. That can range from 50%, 75%, up to 100% in certain cases. The death benefit guarantee is a guarantee that's paid out upon your death. Again, it can range from 50% of the protected value to 75% to 100%. Now, the benefit here is that, let's say just before you passed away, the market took a downturn and your original principal dropped below your market value dropped below your initial principal. So you invested $100,000 and you have 100% guarantee in your seg fund, and just when you pass away, the market dropped to 90,000 or 75,000. Well, your beneficiaries in this case would receive the full guarantee, 100%, so $100,000. So it does mitigate some risk by using a seg fund. It is important to note that seg funds are only offered by insurance companies in Canada and not the banks, particularly because the guarantees are insured by the insurance companies. As far as having seg funds in your RRSPs, if you are going to be leaving your RRSPs to a beneficiary, then you're bypassing probate anyways. So the name beneficiary benefit that a seg fund does provide is already built into the RRSPs. So there isn't a big benefit there. Seg funds do have other benefits as far as guaranteed income benefits that might even outperform, or sorry, might be above what your RIF minimum is. One of the pitfalls, or I guess trouble spots that retirees can run into, is that as they get older and the RIF minimum percentage increases, so the amount that they have to, the percentage of the market value that they have to withdraw in a given year increases as they get older, and at the same time they experience a market downturn, their actual hard dollar value of income can be reduced significantly. Certain types of segregated fund contracts create guaranteed income for life, and that can certainly help to smooth out or create some predictability in someone's retirement income. And as a financial planner, anything we can do to create more predictability in retirement income makes our job way easier. So I hope that answers your question. Oh, I guess I should also note that with those guarantees come higher fees. So seg funds do typically have higher fees. And so if you are considering using seg funds, I do recommend you compare the higher fees, the drawbacks of the higher fees with the advantages of the seg funds themselves. They're not for everybody. Is there any more questions? Okay, well, as I was about to say, I either explained this really well or I put all of you to sleep. But either way, that does conclude everything, our presentation for tonight. Like I said, the recording of this will be available shortly in the next couple of days. And I hope you guys can all join me for the next webinar. Thank you so much again for taking the time out of your evening to attend this webinar. And I hope you got some value out of it. Everybody have a great night.